So let's talk about mapping. Being able to understand and explain what the risk is to your client is very important. So you need to understand how to read flood maps and how to understand what they say and provide information to your client based on what the maps are telling you. So determining flood risk is a huge responsibility. So the flood insurance rate map will provide information based on the base flood elevation that's rounded. Now our newer maps are not going to round that base flood, but you know, if it's between two cross sections, you have to know what the base flood is for that specific location. And that's why we have the flood insurance study, and the surveyor should be using the flood insurance study to make those determinations of base flood, and not, if it's exactly between the cross sections, it may not be exactly half of that difference. So it has to be determined very specifically on the distance from a certain cross section. It also provides identification of special flood hazard areas. Those are darkly shaded areas on the map. Light shade are areas of the moderate flood zone, used to be called B zones. Now they're called shaded X, or the 0.2%, or in an old term, the 500-year flood. But we don't like to use the 100-year and the 500-year because people think it's time, and it's not time, it's probability. It also provides, in where we have determined floodways, what the floodway delineation is on that map, and that's the area that's been set aside to carry the base flood through the channel. So you've got a legend on your flood insurance rate maps. Of course, many of you may not be looking at flood insurance rate maps. You're getting zone determinations from companies who do that on behalf of the Write Your Own companies or on behalf of the mortgage companies, but you really need to look at the maps and look and see what the risk is, what surrounds that property. It could be on the very edge of the floodplain, but outside of it, the risk may be a little bit higher. So you need to know what the risk is for your client. So this is a list of what types of flood zones we have. A's, beginning with A's, are riverine flood zones. Then we have our low to moderate risk flood zones, B, C, and X, depending on whether it's a newer map. Our V zones are velocity zones, some type of wave action greater than 3 feet. Something that you're seeing on new coastal maps is what we call a coastal A zones. Those are what we call LIMWA, limited areas of wave action, moderate wave action, and those will have a different connotation to them on the map. And that's where really our mapping is far exceeded our regulations. We suggest, but we don't regulate, that it be built to the V zone standards. But it's not required. It's encouraged but not required. As we rewrite our regulations, that will get caught up for that. So those are the types of flood zones that they have. Each one means a little bit different. A1 to A30 is an old name that we used for many, many years until we started program simplification. And then we consolidated that A1 to A30 into AE. Same way with the V zones, V1 to V30, into the VE flood zones. AO are shallow sheet flow, AH is ponding. A99, we don't have too many of those, but they're becoming more popular. Those are where levees have been decertified and are in the process of reconstruction. So those are the different type of flood zones and what each connotation means when it comes to what that flood zone is and what has to be done. So let's talk about map changes. And map changes become a very important piece to the agency in order to be able to look at risk and advise your insureds what their risk is or what it's going to be. And sometimes you may not find out about a map change until after it takes place. But we actually, the process for changing a map takes years to get there. And when we present the maps to the community through a special meeting, then we present that to them, and then they should be notifying their insurance agents, their real estate agents, their community officials of the changes that are coming, and that where they can view those changes, whether it be on the community's website, whether it be in a meeting, whether it is in the permitting office. As an insurance agent, you need to be aware of what's going on in the community. So here's an example. In this graphic, this is Centennial, Colorado, who's undertaking a very large mapping revision in there. So in Centennial, this particular area near Euclid, East Euclid, was not in the special flood hazard area. So it's in a B, C, or X zone, therefore it's eligible for preferred risk. But the new map makes it look like this, and the areas are going into not only special flood hazard areas, but in a floodway, which means that area is going to be carrying the water during that base flood. So it's really at a higher risk for floodplain management and for risk, but for insurance purposes, we rate it, whether it's in the floodplain, floodway, it's rated the same. So you need to be aware of what's going on in your communities. Remember that team that we talked about, the community official for an insurance agent, knowing who the community official is and how to contact them is very important. So we have 5 scenarios when maps are changing that you as an insurance agent need to be aware of. First one is newly mapped into a high-risk area. Second one is removed from the high-risk area. 3, change in the type of high-risk area. 4 is a change in the base flood elevation, either up or down. And 5 is no change. So let's start with newly mapped into a high-risk area, because this is the one that is very critical and is time sensitive. So if the more information you have in your pocket that you can present to your clients or are aware of, the better for them. So when we're in a D, a B, a C, or an X flood zone, and property owners are moved into an A or a V zone, you need to provide information to your client that of the increased risk for flooding. Now, it didn't or it doesn't change when the map goes effective. The risk is there. It's always been there, and you need to let them know that that risk is there and that they need to protect that even though the map has not gone into effect. And the easiest way to lock in the better rating is to write that policy before that map goes into effect, because floods can happen anytime, anywhere. You need to advise your client that within probably 30 or 45 days, the mortgage company is going to send them a letter that says, hey, you're now in a special flood hazard area. We must require flood insurance. Oh, and you've got 45 days to get that coverage, or we're going to place it for you at a higher rate. But we also have, importantly, is the newly mapped procedure. Remember, I talked about locking in the flood zone. So under the newly mapped procedure, they have 12 months from the date the map goes effective to put that policy into effect. 12 months. So there's your time crunch. So the more notice you give to your clients, and you should know what clients are being affected by this, the better for them. If they buy the policy before the MAP goes effective, they can get a preferred risk. When they get a preferred risk, they can carry that for at least a year, maybe 2 years, before it gets switched to the newly mapped procedure that's going to be about 15% higher than the preferred risk. But it's a lot lower than if you wait until after that MAP goes effective and after that 1 year time frame, and then they have to go to actuarial rating. You don't want that, and your clients are not going to be very happy with you. There's a change in the type of high risk area, meaning it goes from an A zone to a V zone, from a riverine to a coastal. We don't have that much in Region 8 or in some other regions, but I will tell you along the Great Lakes area, they're getting V zones. They've never had them before, so they're having to deal with V zones. You've got V zones on the coast, East Coast, West Coast, on the Gulf. So for those of you who are writing policies in those areas, you need to be aware that that carries a higher risk, not just for insurance, but for floodplain management when structures are damaged. But you do need to let them know that there is a change in risk. Mandatory purchase still applies. That's not being waived. And the grandfather rule applies. Then we're looking at if you write the policy while it's in a riverine AE situation that's moving into a VE, continuous coverage is very important, as is built-in compliance, being able to document that that structure was built to A-zone standards for that community. So you have one, if it's a pre-firm structure, one chance to lock it in. Post-firm, a little bit different. They actually have 2 chances. One is before and one is after. Continuous coverage is for pre-firm structures. Built-in compliance is for post-firm structures. So they need to provide documentation. So as an insurance agent, remember we were talking about collecting documents? Those documents are showing that built-in compliance are a very important part of your file. Number 3, there's a change in the base flood elevation. Flood zone remains the same, but if the base flood elevation goes down, the risk goes down. Base flood elevation goes up, the risk goes up. And again, it comes back to mandatory purchase still applies, grandfather still applies. If a structure was built to a lower base flood elevation, we're going to grandfather that lower base flood elevation until the structure is substantially damaged or until it's substantially improved. Remember, we talked about very early on in the presentation of what that substantial improvement, substantial damage was. And that's where the improvement or the damage is equal to or greater than 50% of the market value pre-improvement or pre-damage, okay? It's kind of like new construction, and it's got to meet all the requirements of the current floodplain management requirements for that community. If the base flood elevation goes down and it was built to a higher standard, well, good for them, because we're still going to give them that higher standard. So if the base flood elevation went from 5 to 3 and it was built to a 5-foot base flood elevation, it becomes a +2. Now in this case, the agent, you, need to take action, because we're not going to change it when the base flood goes up, but when the base flood goes down, you have to take an action on behalf of your client. You have to endorse the policy that shows that the base flood elevation has gone down, therefore the risk has gone down, but the premium is going to go down too. So that's a good thing. So in grandfathering, base flood goes up, we're going to honor, we're going to lock in but you need to lock in before the change of the map. So number 4, it goes out of the high-risk area. You go from A or V to a B, C, or X. People say, hallelujah, I don't have to have flood insurance anymore. Well, low risk does not mean no risk. Just because it goes, the flood risk goes down doesn't mean the risk goes away. It's still there. It just may not be as deep. As an insurance agent, you want to make sure that that continuous coverage is there, but one of the things you can do is change it to a preferred risk policy if it meets the preferred risk eligibility for loss history. Yes, flood insurance is optional, but you really need to encourage and recommend that they keep that policy, but you do need to change it or convert it to the preferred risk. Last, no change in zone, no change in base flood elevation. Does that mean you don't have to do anything? No, you really need to say, let me look at my book of business for flood. Let me look at, do they have enough coverage? Do they have contents coverage? And make sure that you review that coverage with them to be sure that you don't need to add coverage or take away. Maybe they don't live there anymore. It's a rental house. They have no contents. So you just need to look at the whole risk and see if there are any changes that need to be made. Protect your client. But I fooled ya. There's actually an extra one. And those are those close calls. So structure is close to a special flood hazard area, but just outside, the risk is almost the same. It's just that we didn't map it in. So those close calls, you need to really talk to the clients and say, hey, did you know that the high-risk area is just across the street or just behind your house? If it's not mandatory, nobody's going to let them know what their risk is. They're not going to think about it. So again, counsel your clients on those close calls. Preferred risk, if it's not in the special flood hazard area, is a good way to go. Say, hey, by the way, for less than a cup of coffee a day, you can get flood insurance to the maximum available. Make a point to them to let them know that they really need to protect their risk. They're not free from it, but they need to protect it, and it really doesn't cost you that much. So there are other ways to determine close calls. You can look at the standard flood hazard determination form from the lender or from your own zone determination from your company. You can also do letters of map change. They can apply for a letter of map amendment if the structure is on natural ground or if it's been elevated for fill. It can be done through the letter of map revision based on fill. Both of those will be determined by an application that you can find online, a copy of the elevation certificate or any other supporting documentation that is required for that letter of map change application. You can find more information on FEMA's website. Again, go to FEMA.gov, type in letter of map change, or go to Google and do letter of map change and it'll bring it up. How do you view the maps? You've got the map service center, msc.fema.gov. Type in an address and it's going to bring up the flood map. On our newer maps, you're going to see an interactive map that you can actually put an aerial photograph underneath of it and make sure you're looking at the right structure. So there's also assistance through our map service center, 877 FEMA map 336-2627 that you can call and they'll help walk you through there. You can also call our NFIP call center and get some information from there. So what is the best rate? Option 1, buy the insurance before the map changes. Lock in that flood zone. Start that continuous coverage. Option 2, use an old elevation certificate, old flood zone at the time of construction. That's what we call grandfather. Make sure coverage is continuous on that. Particularly if you're a pre-firm structure and you're using optional elevation rating for that pre-firm structure. Option 3, you've got the newly mapped procedure. Write the preferred risk before the map change. It'll automatically move into the newly mapped procedure. You won't have to do anything. If you wait until after the map changes to do an action, you've got that time limit of 12 months to make the policy effective. And last but not least, maybe the new map and the new base flood elevation is better. If the base flood elevation goes down and the structure was built to that higher standard, your premium is going to be based on that higher standard. It's kind of like grandfather in reverse. So what may really be at base flood, but it was built 2 feet above base flood, now you get a +2. That's 75% savings on the premium. So it's important to keep that going. So how does that equate in premium? Been asking that all along, haven't you? So if you write a preferred risk, now these are rates based on October of 2016. Pre-firm structure, maximum available, 250 on building, 100 on contents. Premium is $519. So they'll have that premium for a year or two, and then they'll move into the newly mapped if the structure's moved into an A zone. And that premium goes to $585 as an example, same amount of coverage. If you miss that rating prior to the map going effective, but it was built to a B, C, or X flood zone, and we're going to use the standard rate, that premium is $1,785. Now keep in mind these premiums are going to go up on an annual basis just with our overall rate increase based on inflation. So what kind of messaging do we want to give to our stakeholders? Increase in base flood elevation or mapped to a V zone. Pre-firm or post-firm buildings can lock in the base flood elevation and zone by policy before the map changes. Post-firm buildings can lock in the base flood or zone after the map becomes effective, but must show it built in compliance. Okay? So what about substantial damage and substantial improvement? I don't think I can say this enough. Is once a structure is damaged or once it does an improvement that is equal or greater than 50% of the damage before the event or before the improvement, is like brand new construction and is rated like brand new construction. So if it's not at base flood or higher, it's going to pay a higher premium. Mapped outside of a high-risk area, even though the mandatory purchase has been lifted, it sure is needed because it's still in a flood zone. Low flood zone does not mean no flood zone. Lenders can still require it by mortgage contract. And over 25% of our claims come out of these special flood hazard areas in low to moderate risk areas. And that number is rising as we have greater storms, greater localized storms that we don't account for in our modeling for maps. We're seeing more and more flooding occur outside of the special flood hazard area. It's easy to convert to a policy to a low cost PRP when structures go outside of special flood hazard areas. When there's no change in the flood risk, ensure that structures are still covered for flood insurance, still subject to flood damage, and make sure they've got enough coverage. One of the biggest comments we hear when I go out on disaster is I only bought what the mortgage company required. I didn't think it would ever happen to me, and now I've lost everything that I've accumulated over the years. So think about your client, think about what he could lose, and think about his emotional state when he has to go through this, because it will flood.